Welcome to today's Explainer. On May 10th, the Prime Minister explicitly talked about reducing gold purchases. And then, boom, right after that, a 15% import duty gets slapped on gold. Message received, right? But here's the crazy part. Just days before that duty hike, India's biggest stock exchange quietly launched a massive new financial tool. So the real question we're looking at today isn't just, should we stop buying gold? It's, can we just buy it smarter? Let's get into electronic gold receipts, or EGRs. Here is what we're looking at today, India's $72 billion gold problem. What EGRs actually are, the 3 steps to how they work, how they stuck up against your other gold options, why they actually failed once before, and finally, the verdict on the National Stock Exchange's new attempt. Let's jump in. All right, starting off with Section 1, the $72 billion gold problem. India's macro reality. To understand exactly why the government jacked up that import duty by 15%, you really have to look at this number. Last year, India drained an all-time record of $72 billion, billion with a B, out of the country just to import gold. That's a massive drain. By sending all those dollars overseas, we are literally burning through the foreign currency reserves we desperately need for essential oil and other critical imports that actually keep the economy running. So the government hikes the duty to essentially say, hey, please stop buying so much gold. But realistically, is that going to solve the problem completely? Probably not. Because look at this wild contrast. While we're out there importing billions of dollars worth of new gold, we already have a staggering 25,000 tons of gold just sitting there, entirely idle. Where is it? It's locked up in Indian homes and temples. We obviously have a deep, centuries-old emotional and cultural connection to this metal. And honestly, that relationship just isn't going to change overnight. So that brings us to the ultimate question, doesn't it? How do we satisfy that deep cultural connection without totally draining our national reserves? Like, can we somehow take all that idle gold sitting around in lockers and bring it into the formal financial system? It wouldn't totally eliminate imports, sure, but it would be an infinitely smarter way to manage the gold we already have. Which brings us to Section 2, meet EGRs, or electronic gold receipts. So just days before the government hiked that import duty, the National Stock Exchange launched what could be the solution. Think of an EGR exactly like holding company shares in your demat account. When you buy a stock, you know you aren't walking around with a physical paper certificate anymore. The ownership is totally digital, but the company itself is very real. EGRs work exactly the same way. The certificate sits right there in your demat account. But instead of a company, it's backed by actual, verified, real gold that's stored away in a highly secure, SEBO-regulated vault. It's essentially the ultimate hybrid asset. You get the total convenience of a digital screen, combined with the hard security of a physical reality. On the digital side, you trade it just like shares, and you get one unified national price. So no more of those annoying price discrepancies between different cities or different jewelers. But on the physical side, it's totally backed by real metal, locked up in SEBI-accredited vaults. Think big global names like Sequel, Malka Amit, or Brinks. Let's move to Section 3. The 3 steps of EGRs, how the system works. The real key here is understanding how this physical gold actually finds its way onto the exchange and how you can interact with it. The whole pipeline is beautifully simple. It's just 3 steps. Step 1 is deposit. Big institutional players like your major jewelers or refiners deposit physical gold into a regulated vault. Now, it has to meet strict international purity standards, but once the vault manager verifies it, they literally just tell the depository to credit the EGRs. Okay, step 2, trade. Now, everyday investors, us, can buy and sell these EGRs on the NSE in real time at live prices. And get this, you can buy fractions all the way down to just 100 milligrams. Finally, step 3, which is convert. This is the absolute magic feature. If you want, you can surrender your EGR on any working day between 10 a.m. and 3 p.m. and take actual physical delivery of the gold straight from the vault. But okay, let's be totally honest here. There is a catch. While trading the digital side is seamless, crossing over into the physical realm is going to cost you. If you decide to convert your EGR into a physical gold bar, it instantly triggers a 3% GST. That's exactly the same as if you just walked into a shop and bought physical gold. Plus, on top of that, you're likely going to get hit with vault and delivery charges. So it's absolutely vital to run the numbers and calculate those costs before you jump in. All right, on to Section 4, comparing your gold options, EGRs versus traditional. Let's see how this shiny new asset actually stacks up against the stuff you probably already have in your portfolio. When you look at them side by side, EGR sits smack in the middle of the spectrum. Physical gold, sure, you can hold it in your hand, but it comes with those painful making charges, sometimes up to 15%, plus the headache of storing it, and you almost always take a loss when you go to sell. Then you have gold ETFs, super high liquidity, great SEBI regulation, but absolutely zero chance of ever extracting physical gold from them. Sovereign gold bonds were fantastic, but the RBI actually halted new issuances back in February 2024. And those digital gold apps, they offer physical delivery, but they're sitting in this weird regulatory gray zone that SEBI has actively flagged. So EGRs, they essentially give you the strict SEBI regulation and the fast liquidity of an ETF, but they let you keep that physical delivery option of traditional gold. Plus, the government has really sweetened the deal here with some incredibly favorable tax treatments to try and push adoption. With EGRs, long-term capital gains kick in at just 12 months. Compare that to 24 months for physical gold. And it gets better. If you convert physical gold into an EGR, or vice versa, converting an EGR back into physical gold, it triggers absolutely zero capital gains tax under Section 47, Clause 7D of the Income Tax Act. That is a huge perk. Now for the drama. Section 5. Why EGRs failed before the 2022 BSE attempt. Here is the massive plot twist that pretty much all the financial coverage is quietly ignoring right now. This is not actually a brand new product. Nope. The Bombay Stock Exchange, the BSE, already tried this exact same thing over 3 years ago. They launched EGRs back in October 2022. The SEBI framework was ready, the vaults were built, everything was set. But today, the trading volume on the BSE is effectively zero. Literally flatlined. Most brokers didn't even bother to enable it, and I'd bet most investors never even knew it existed. So why did it fail so spectacularly? Well, it really came down to 4 main things. First, near-zero investor awareness. Everybody was just looking at ETFs and sovereign gold bonds. Second, they only had 3 approved vault managers at the time, which made physical deposits and withdrawals a total nightmare if you lived outside a major city. Third, and this is a big one, there was a massive supply-side bottleneck. Charging that upfront 3% GST completely blocked the working capital for the jewelers and importers who were supposed to supply the gold. It locked their money up for months. And fourth, the classic chicken and egg liquidity trap. Nobody was buying because nobody was selling, and nobody was selling because there were no buyers. Simple as that. Which brings us to our final part, Section 6, the verdict on NSE. A second chance? So why should we care that the National Stock Exchange is trying the exact same playbook right now? Are we just doomed to repeat history? Well, the short answer is the NSE is not the BSE. While the BSE couldn't get the flywheel spinning, the NSE controls a staggering 90% of India's equity and derivative trading volumes. On top of that, their investor network has been growing at 26% every single year for the last 5 years. If literally any exchange has the sheer infrastructural muscle to force liquidity into existence and smash that chicken and egg trap, it's the NSE. Although, full disclosure, even they are facing some early friction, because a lot of major brokers still haven't fully enabled trading for retail folks yet. Look, at its core, it's a really structurally sound idea. It's heavily regulated, it's transparent, and it's genuinely backed by real gold. If the NSE can actually get enough brokers on board and convince jewelers to create genuine liquidity, this could be an absolute game changer for investors who want a safer, liquid way to hold gold. And honestly, it'd be a massive win for an economy that is desperate to stop bleeding dollars overseas. But as history just showed us, a smart product doesn't automatically guarantee survival. So we've got to ask, will EGRs finally be the key to unlocking India's hidden 25,000 tons of gold and spark the financial revolution our economy needs? Or is this just another clever product destined to fade away in a vault somewhere? Thanks so much for joining me on today's Explainer. And as always, keep questioning what you learn.